Okay, hi everyone. Okay, let's make myself a bit comfortable here. All right, so this is a live broadcast on driving markets. Let's talk about what happened last week and let's talk about what's going to happen next week. Hope you're all enjoying the channel. Just get my microphone sorted out. 1 second. That's it. Hope you can hear me. Let's kick off. So last week was dominated by effectively the Jerome Powell speech at the Economic Club in Washington. And what he stated clearly there was that looks like there are disinflationary pressures in the US, that the Fed and the governors and the presidents of the banks and the analysts, they can all see these disinflationary pressures, okay? So they believe that interest rates are having an impact overall on price of goods and inflation in the US. My opinion is that they've got it wrong, and I have done several several broadcasts, and I've really hammered home that I do think the Fed has it wrong as we're talking. But who am I to say, compared to all these analysts in Wall Street that earn $3-4 million a year and they get paid bonuses and millions to analyze? I'm sure they've got it right, but I think they actually have it wrong. Okay, so it goes as follows. So Jerome Powell made the speech on Wednesday. And he said, talking about disinflationary pressures and the fact that it's having an impact, etc., etc. But there really is an undercurrent of inflation within the economy. There's two undercurrents of inflation. Number one is the retail price index, or the CPI, consumer price index. That is the cost of living inflation. Okay, so the cost of living inflation is what you're spending every day. Okay, the housing, the energy, the gas, the petrol, the food, clothes, maintenance. That's everyday inflation. All right, and that's really costing a lot of money, and you're feeling the impact in your pocket. All right. Now, according to the statistics, according to the numbers that are out there and published by the Bureau of Statistics, they're saying that those prices are coming down. However, if the prices are coming down, how can the consumer in the street, how can the regular consumer feels as though there's got less and less money in his pocket? If housing's going up, gas going up, energy prices going up, food is going up, and general maintenance of everyday life is going up, then how can they say that the cost of living is going down? So the overall basket of goods, statistically, might be coming down, but the feel-good factor, the fact that you've got less money in your pocket, that is there. It's a constant, and it's not something that's going to change in the near future. So 2023, we're going to have high inflation. In fact, I think, in my opinion, inflation is going to rise even further. I think we're going to get to the level of around about 8 to 9% inflation in the US. In the UK, we've already got 10.5% inflation. In Europe, we're going to get about 8.7% inflation across the board, across the 15, 16 countries in the Eurozone. So I think we're going to have a pattern of higher and rising inflation throughout 2023, and it's going to continue rising, and that's going to put pressure on interest rates and on the central banks. In order to fight inflation, they're going to have to raise interest rates. Now, the markets went down last week. Equity markets went down because the fear of inflation is back on the agenda. It's there. They're talking about now another 25 basis point to 50 basis point rise at the next Fed meeting. Okay. So the Fed is now going to see that the inflation numbers are not under control and is likely going to raise interest rates even further, putting more misery and more pain on the mortgage holders and on anyone who has any type of loan, whether it's a car loan, a bank loan, overdraft, business loan, mortgage, commercial loan, whatever the case may be. There's going to be more misery, more hardship on the actual borrower. All right. So there is going to be a trend of rising interest rates, and we can't avoid it, and we can't ignore the fact that rates are going to go up. I know a lot of people are dreaming and hoping that the rates are going to come down or they're going to stabilize, but they're not. They're actually going to go up, and we're going to end up with around about at least 6% interest rates, in my opinion, by June, July, and maybe even higher throughout the rest of the year. All right, so interest rates in 2023 are only going to go up. Now, looking at actual financial markets and equity markets, what you're going to have is a big impact is going to be on the high-risk assets. You're going to have the NASDAQ, which is high-tech stocks, are totally dependent on new money coming in and cheap money, but money's not cheap now. So any NASDAQ stock or any high-tech stock or high-risk asset is going to be impacted by rising interest rates. As interest rates rise, then what's going to happen is that high risk asset is going to tumble. And that also applies to cryptocurrencies, because cryptocurrencies are a high risk asset. And you've seen that Bitcoin has been struggling to get there. It's been struggling to get above the 23,500, 24,000 level. So therefore it's unlikely to get there. It's most likely to go back towards the 19,000 level or even lower. It's a high risk asset. Okay. And talking about the other high risk stocks, you've got the Meta, the Amazons, the Googles, the Salesforce, the CRMs, all of those, Tesla, all of those stocks on a high interest rate environment are going to end up falling and going to end up dropping even more. So Tesla has already gone up to $208, $209 a share, likely to go down all the way back down to $140 a share. The equity markets in January have just gone up far too high, and they've gone too fast. Too high, too fast, and we're looking for a major correction. Remember, I've said all along that in 2023, I expect there to be a significant market crash in 2023, around about 25-30% drop in 2023. Looking at the week ahead, so the week ahead you've got CPI coming out, and you've got PPI, and you've got retail sales in the States for the January period. Okay, so CPI, the Consumer Price Index, which is an inflation measure at retail level, coming out on Tuesday. They're expecting a 0.1% drop in that. I think it's going to actually shock the market. It's going to be much higher. And then you've got retail sales on Wednesday. Again, retail sales is a big measure of where the health of the economy is regarding consumer spending, regarding sales. So if the retail sales is higher than expected, then you're going to have you should technically have a jump in the equity markets. However, because retail sales being higher than expected could mean that the Fed will end up putting up interest rates, so equities could end up going down if you have a strong retail sales. It's a bit of a paradox where normally you should have a rising market if retail sales are good, but in this particular case, because of a high interest rate environment and worries about inflation, then you could end up with a lower you could end up with a dropping market. Okay, Thursday you got PPI, Producer Price Index. That's inflation at the producer level. All right, and that will give us a good indication what the producers are paying in order to get that product produced, and that will feed down into the retail sector. So if that's high, then obviously you're going to see retail inflation CPI higher than expected. All right, that's it for the live session at the moment. I don't really want to bore you to tears. You can catch me normally on a regular YouTube or on TikTok or on Instagram. Catch you later.